Again, thank you for joining. My name is Jeff Lusick. I'm the head of the retail sales team at Horizons ETFs. Thanks for joining our webinar that we're referencing the LRCN rally, the new preferred share landscape. Whenever we do a webinar, I always like to reference or think about why we're holding this type of webinar. And preferred shares have been a widely discussed topic for many years now. They have had a nice bounce off of the bottoms in the lows of March, but also in the last 3 months or so we've seen an additional rally, and we like to call that the LRCN rally, and that's what we'll be discussing today. And also because traditional fixed income, especially government bonds, have done so well, their yield has become so low that this is an opportunity to look at preferred shares, which have a nice tax-efficient yield that can complement those lower yielding government bonds right now. So just setting the table for today's presentation. In the top right corner of your webinar screen, you will see, or actually in the bottom of the tool tab, you'll see handouts, and in that handout bar, there are the product sheets for our two active preferred share ETFs, HPR and HFP. And you'll also see a most recent commentary by Fiera Capital for the ETF HPR, as well as a white paper that Fiera Capital wrote that's referencing a lot of the details that we're going through in this presentation. We'll be presenting for about 30-35 minutes. We'll allow some time for questions. If you do have questions, please enter that into the question bar, and we'll try to address those questions either throughout or at the end. And if we're not able to get to all questions, we'll try to respond individually after the presentation. So with the agenda, we're just going to review what limited recourse capital notes are, and you'll hear us refer to those as LRCNs, how these LRCNs have impacted the Canadian preferred share market space. We'll also provide an outlook for the Canadian preferred shares and just a quick review of the offerings that Horizons has via our ETFs. So we have at Horizons, we've been fortunate to partner up with Fiera Capital for over 10 years now. They are the sub-advisor of a lot of our actively managed fixed income ETFs that we offer. We've had a lot of success with the integrated fixed income team at Fiera Capital. They do manage our preferred share ETFs, HPR and HFP. That team I mentioned, the integrated fixed income team, oversees $28 billion in assets and more than $2.5 billion in Canadian preferred shares. There are 6 investment professionals on that team, so a very deep team of analysts and portfolio managers that are constantly reviewing this space. And that team goes through rigorous independent credit analysis, making sure they're comfortable with all the holdings in the preferred shares ETFs that we offer. And Nick Normando has joined us today. He is the lead on the preferred share mandates, a member of that integrated fixed income strategies team at Fiera Capital. He has 18 years of industry experience. He has a Master's of Finance from the University of Sherbrooke, and he's a CFA. And we're fortunate to have him today to sort of walk us through the LRCN issuances and how that's affected preferred shares and the opportunity that now presents in the preferred share market space. So Nick, I'll pass it over to you.
All right, thanks Jeff, and good afternoon everyone. Last time I was checking, we did a webinar and it was in February, this year in February 24th, so a lot of things happened, I would say, since then. And so we're gonna go and jump right away. So the pref market has been extremely volatile this year with the pandemic and the recovery, and now the LRCN market, and we can kind of catch all those volatility within the last quarters, right? Q1 was all about the pandemic, so wider spreads, lower rates, not a really illiquid market, right? So lots of volatility, and the pref market really performed badly in this environment, almost minus 23% for the first quarter only, right? That this was the worst quarter ever for the asset class. It reversed pretty well in second quarter, right? Despite the rates that continue to decrease, but that was all about the recovery, the reopening of the economies, right? After the pandemic, which was still on the pandemic, right? But so a much better credit tone, much better equity tone. So pref kind of performed well in this environment despite the low rates environment. Q3 was all about the LRCN, really, right? When RBC was the first bank to issue the LRCN, we'll go in much detail exactly what it is, but it was at some point it was kind of not expected, but it was kind of normal to see Canadian banks being able to issue these type of hybrids to the bondholders, right? They were almost, if not the only banks in the world issuing their most riskier fixed income assets to the pref market, which is still more retail market, right? So when you were comparing, let's say, U.S. banks and European banks, they were all able to issue hybrids already in the U.S., in Europe, right? Already to the institutional investors, right? So finally, Canadian banks were able to get global valuation for hybrids because the pref market was way too expensive for them, right? Plus, they got some good news with the LRCN for the AT1 treatment from the CRA also as its interest income instead of dividend income. But it was, I think, a real game changer for the asset class, and that kind of shows how the Q3 performed much better, the pref market much better than everything else, right? Even better than equity in that quarter. So that was great. So next slide. So what's the LRCN, right? So first, it is, like I said, paper issued to the bond market, right? So it is considered AT1. It is a corporate bond. It is a pari passu to the preferred share market. So it is senior to equity, but it is lower in the capital structure versus senior debt and sub debt, right? So what a bank do when they print an LRCN is that at the same time they issue a reset, a preferred share, right, into a trust, and the investors that are buying the LRCN, the only recourse is the preferred share that is in this trust, right? So it's a corporate bond, like I said. It's 60-year non-call 5, right? So which means that it is callable every 5 year, right? Like a preferred. So you have a reset. Of course, when you buy this, you want to have the highest resets possible to reduce the extension risk. And if they do not call you at year 5, the new coupon you'll get is the 5-year rate Canada plus this spread, right? And they can extend you for 60 years, right? So this is kind of the main thing with this paper. Also, you can be converted at all time into a preferred shares, right? There is no reason for the bank to convert you unless they're in trouble, because remember, these LRCN are giving you interest income, while on the pref side you're getting dividend, right? So for them, there's no reason to convert you for fun, right? So but you should expect to be converted if at some point the bank is in trouble. And by the way, those are also in BCC, like the sub debt, like the preferred share. But we could see scenarios that the bank is in trouble, so they need to kind of, let's say, cut the dividend on the equity, cut the dividend on the pref, and now they would convert you into a pref, right, and stop paying you the dividend, and without really triggering any NBCC thing, right? So this could happen. Or you could also be converted at year 60 if the bank is not calling you, because there's no other options, right? So, and the reason the bank would do it is because it's the market tone for LRCN has deteriorated, and it's just cheaper for them to extend you and to convert you into a pref versus redeeming the LRCN and reissuing a new LRCN. So those are the main those are the main factors. I would say it's a bit like a preferred shares, right? But with a nice Halloween costume, I would say. You should expect the same type, probably a little bit less volatile, but much volatile than sub debt and senior. Less volatile than preferred because I think liquidity on those are much better than in the preferred share market. So that's, I think, a good thing. But investors let go a lot, right?
So Nick,
Just on the dividend versus interest.
Nick, for clarification, so they are similar to the rate reset in the sense that they're a spread over the 5-year government of Canada, but this is more advantageous for the bank. It's a cheaper use of capital for them to issue these. Is that correct?
It is now, right? And that's the reason why it's so successful so far, right? And I'll show you later on the levels banks were able to get, and that's kind of the main reason why they're issuing now their AT1 through these LRCN and not preferred. It's because they're saving a lot.
Okay.
And it's pari passu to a pref. They're giving you the same capital treatment like a pref. And but it's cheaper for banks to issue those versus a pref right now. Okay, so switch page. OSFI cap the banks to 50% of their risk-weighted assets of the AT1 bucket, sorry, which is 75 basis points. So banks cannot print more than 50% of the AT1 of those LRCN. Which means for banks, at the time we look at it, that means they could print up to 16.7 billion, right? Of those paper. They have already issued a lot, so this was before that. So far, banks were the only one printing, but in the future, it is also possible that we see life insurance follow the banks with those LRCN. It's unclear exactly what will be the rules, but OSFI is looking at it with those issuers, and this could mean also another almost 7.6, 7.5 billion of potential supply of the LRCN from those life insurance company. Next page. So, like I was saying, Jeff, it is a massive success since the launch of those. So they print close to the banks altogether. They print close to 5.7 billion of those LRCN. So we had 6 deals so far, 2 by RBC. RBC print the first one in July, and they just print another one just last week, right? So altogether, RBC, they have print so far 3 billion out of almost 4.2 billion, right? Assuming that OSFI does not change that limit, but that's the assumption right now.
Right,
and I think,
Nick, and I noted Royal was the first one to launch with that 4.5% spread, and then I noticed the other banks saw how popular that was, and they were able to issue shortly after at a lower spread. Is that correct?
Yeah, that's correct. And you can see this on the chart, right? So the first issue was launched, like I said, by Royal at 450, and you can see the other banks following in September and then in October, right, at 430, and even like the last issue, RBC print was 4%, so 50 basis point better for them versus the first issuance, right? So which is a really good trend, right? And you can see also, which is the last column on this table, is the preferred share equivalent reset level, right? So it's really starting from the coupon of the LRCN and switching it, which is interest, switching it into a dividend, right? And less the 5-year rate Canada. So you could see that the first time RBC print their LRCN, the reset, which is, you could see at 414 almost, right? This is for the LRCN reset, but this is equivalent to 332 as a preferred share, right? So you could see that RBC last week, because the tone is improved, they were able to get the preferred share equivalent reset level was 289, and this is really important because it will come to my other page for the assumptions of what we think. Why it's so great for the pref market is because we are expecting a lot of redemptions that will happen right in the pref market, because they will slowly but surely redeeming all the expensive preferred and replacing them with those LRCN that are so cheap for the bank right now versus the pref out there, right? So this is why we think the LRCN is a game changer. This is why we think preferred share market will continue to perform extremely well. So flip the page. So today we're expecting for the next 7 quarters, up to a little bit more than 12 billion of redemptions of preferred, right? This is massive. The market is like 65, 66 billion, right? So it's more than 18% of the market will disappear over the next 7 quarters. And you can see that it's almost like the bunch of the redemptions will happen next year. So in Q2 and Q3 of next in 2021, right? But every quarter we will see a little bit of redemptions. Constant redemptions up to Q2 2022, right? And what's important here is that we put some assumptions, right? So remember, like Royal Bank, they were able to print the LRCN with a preferred share equivalent reset of 289. So the assumptions, what we're doing here is that we think all the rate reset you see as a redemption as a reset of 380 and better, right? So we are really conservative, right? But you can still see the big amounts of redemptions. It's not just banks, right?
And Nick, did RBC redeem one of their issuances at the start of October for about $1.5 billion, and was that earlier than anticipated?
Yeah, RBC has redeemed some Royal Bank perpetual non-NVCC, so that was not a surprise. Maybe the timing was a surprise on those, because they had another year, let's say, to call them all, right? And this 1.5 billion, it's not included in this table because it happened in Q3 2020, right? What was a surprise though, BMO and TD redeem some perpetual NVCC compliant, right? At the first time they could, let's say at $26, so $1 premium. So that kind of tells you how much they're saving on the other side. They're ready, and banks, we all know that they don't like to pay premium, but they were willing to redeem them at a premium because they were saving so much on the other side, right? So far we see all the banks that have print. The only two banks that did not tap the LRCN market is TD and Scotia. They will do it. It's just a matter of time. Quarter end for banks is coming in 3 days, right? But we're expecting that both banks could print late this year once they report, so late December or maybe early next year in Q1, because they will have some redemptions to deal with. So those redemptions would clearly bring a bid in the pref market, right? We do not think though that they like whatever redemptions will see a 1-for-1 dollar being reinvested in the pref market, but we will see some of them, right? And we all know that my friends CPD and ZPR that are passively managed, well, whatever redemption they get, they'll have to buy the pref market. We saw how CPD, the great job they did, and I'm sarcastic here, on the last day of the quarter when they got all the money from the RBC non-NVCC one. So they will continue to do that going forward, right? So which is great, because remember, the pref market was always lagging in terms of performance, and that was because the technical were negative, retail were reducing, they didn't like the volatility. But now with all those potential redemptions, I think that the technicals are finally becoming positive for the pref market, which is great news, right? So I said it's not like done deal, right? You remember, like the preferred, your perpetual by definition. So to see those redemptions, we need to see the credit tone, the equity tone, of course, not to see the pandemic deteriorating, right? And to see the LRCN market kind of holding well, right? But we're putting in, I think, conservative amount, because even if LRCNs are widening by 100 basis points, it's still good, right? They will redeem them to replace them with those LRCNs. So we're pretty conservative on our number. And guess what? If the pref market, not the pref market, but if the credit tone and the LRCN market continue to improve, we could see more redemptions, right? I was looking at banks and life insurance with resets in the low 300 to, let's say, 380, and that's another 8% of the market potentially being redeemed. This is after 2022. So that's kind of the main reason why we think the pref market is cheap. Yes, the market has recovered since with the announcement in July, right? But there's so much more upside possible, because the amount is really big.
Good.
Okay, so next page. So here it's more about what happened really, and the market really focused in Q3 with the announcements on the LRC, and really they focus a lot on the banks, right? Forgot about that life insurance might also be part of those LRCN party, right? And first, right? But they kind of insurance performed pretty well late in Q3. But also, I think the market is really forgetting that it's not just banks and insurance that have access to this hybrid LRCN market, right? But the non-financials too, right? The good names like CU, Trap, Emira, Enbridge, right? They all already have access to the hybrid market in Canada and the US, and they're also saving a lot because these are interest versus dividend, right? So we and it was kind of shown in the previous page, but we're also expecting some redemptions of the high resets, high coupon for those non-financials, right? But we can see that here in this table, I think what I wanted to show you is that on the bank side, we saw like the mid reset and low reset, let's say for Royal Bank, really perform extremely well versus the high reset, right? And this is normal, right? The high reset now are all trading above par, market is expecting they'll disappear and it's all good, right? But when you look on the year to date, you can see yes, also like the banks are performing okay on the low and mid reset. Same for Manulife, right? But when you look at those Enbridge and BCEs, yes, they perform better in Q3, but they're lagging big time the rally for the full year, right? So I think there's still a lot of upside, and I think the market should focus a bit more too on those notes financial, because all the redemptions what we'll do, yeah, they might not redeem as much as the high resets from the Enbridge and Trap, but they will also beneficiate of those massive redemptions in the overall market, right? So, and they're good names too, right? So this is really what I wanted to show you. Next slide. So despite all this, despite the strong performance in Q2 and Q3, the yield for the asset class is at 5.33. This is a yield as of September 30th, but this hasn't really changed much since. And so after tax, you're 690 approximately, and this is much better than high yield, right? High yield here we showed 576, but really where we are today, and market continues to be strong, we're at 540. So the pick in yield versus high yield is 150 basis points on the after-tax basis, which is massive, and it's also a really great pickup in yield versus the bonds. I know it's not the same risk and volatility, I get it, but the yield reason to buy the pref is still in, despite the huge technical of all these redemptions that we don't see and don't have in US pref, and that we're still underperforming the US pref in Canada. We don't have these potential redemptions in corporates in high yield and equity, right? So that's kind of another reason why I think this asset class is still attractive. Next page. Next slide. Thank you. So for HPR, what does it mean, right? So we have a little bit better yield. We're at 559. Let's call it 560 versus 533. You all remember what this yield is coming from. This is the current year right now, but for all the rate reset that we think will get redeemed, that traded premium, we're looking at a yield to call. So it's a kind of a yield to worse analysis, right? So there's a little bit of downside down the road if rates stay that low, but you'll see that it's not that bad. So after tax HPR, we're at 7.3. This is great yield, I think. Yes, we have a little bit more P3s, but most of the overweight is coming from overweight in great names like BCE, CIBC, National Bank, or REITs like, not REITs, but utility like Emira, Fortis, Brookfield Renewable Power. So it's all good name. Yes, rated P3, but it's all good companies, right? So the weaker names, we are underweight, right? So far, you could see on the right-hand side that the hybrid exposure / LRCN is extremely low. In fact, we have 0 LRCNs. Now we think that the pref market is still much cheaper than the LRCN market. It might change at some point in the future when we'll see all these redemptions, but we're not there yet. And so far, we're right. Yes, the LRCN performed pretty well since July. They're up, what, 3-ish%, but the pref market is up 12%, right? So generally speaking, in banks and life insurance are up much more than that, right? On the bottom right hand side, the table, this is the most important table to recognize the bet we have on. We're at 50% of invested into preferred trading below $20. That's 15% more than our benchmark. So we're still axed toward a trade that it's kind of a bull market, that the redemptions will be net positive for the pref market, and that those that trade at discount, well, they will outperform the ones that trade above par, and that has not much upside anymore, right? So we're positioned that way. And in fact, that's going to explain why in Q3 HPR before fees, we had 134 basis points. And we think that we have the right trade to outperform in the environment of all those redemptions. And we even beat ZPR, that is 100% reset, right, this year. So it's not because we have a little bit of perpetual that we cannot beat them. It's all about selection and the resets, and you'll see on the following pages. Please switch page 13. So which bring me, let's say, to the structure allocation. So you can see, like in perpetual, in fact, in all structure, we're pretty similar to the benchmark, but it's all about which one you're choosing. And you saw just the previous page that we have 15% more of the one that traded discount, right? So perpetual, they're kind of good, right? It's just that I think that upside is limited. Downside too, we don't think rates are going higher anytime soon. But most of them now are trading at premium, and so upside is kind of limited, but they're kind of, I would say, better than first, they're much cheaper than the perp in the US. That's important in spread, right? And even in yield. And they're, I would say, even better than the high resets that we're kind of selling these days with yield to call of low 2% that are just zero value anymore, right? So that's it for perp. We're not really looking to add because we think there's more value in the rate reset, but they're kind of okay. So, and it's also good to have some position in those that are usually much less volatile than the reset. But on the right hand side, you can see all the allocation within the sector, right? And you can see that we're the gray bars, and really our overweight is in good sectors, even in the pandemic environment, like utility, telecoms. We're underweight in real estate, right? We're overweight in insurance. And in banks, yes, we're underweight, but like I said, it's all about which one you're picking, right? And because when you do not count the high resets or whatever is 400 and more, we have more than CPD, right? Which is, I think, extremely important. On next page. So average resets is around 311. And really the sweet spot for us, if you look on the left table, on the bottom left table side, and the sweet spot for us is whatever has a reset between 250 and 300, right? This is where right now we think there is still a lot of value, right? And you can see that we have much more than the universe at what, 23% versus 16, right? I would say that at first, like when we got the news in July with the LRCN, we were really kind of chasing the, let's say, between the banks and life insurance reset between 300 and 400, right? Not the 400 plus, because it was kind of too late to buy those, which they perform extremely well. But now I think the sweet spot really is in, let's say, bank resets and life insurance resets that are between 275 and 300. I know it might be technical here, but those are still trading $5 plus discount, right? And remember, where is the break even for those at RCM? RBC just print with a 286 break even, and we're able to buy still those preferred shares with 274. Even two of the TDs, TDFE, TDFD, that's reset like bigger than or similar to this LRCN, and they're still trading at $5 discount. It's massive, right? I'll take that bet anytime, right? So this is the sweet spot. For the low resets, we see that we like 250 and lower. Really, our bet is axed towards the non-financials. Really, that's where it's cheap, right? The banks are just okay. They might just kind of continue, but they will never. I should not say never because we don't know. But the chance of seeing redemptions of the preferred with a reset of 220-ish is really limited, I would say, right? They don't really have to improve a lot before we saw that. And also remember, there is a limit to how much LRCN they can print right now. So in the future, unless OSFI change the rules, it will be 50% LRCN, which they'll go quickly towards the limit. And after that, it will be a mix of hybrids that they can print in the US or preferred, right? So that will prevent right now the banks to redeem all the pref, right? And maybe to see more supply of preferred down the road, but we're not there yet. On the table on the right hand side, not much change on that, right? We try to have a nice allocation toward the years for the rate reset date, right? The 2023 resets, it's not the first time I said that, but it's always like that. It's pricey, right? It's the last time I know that we reached kind of highs in the 5-year rate Canada around 2%, and people think that the yield they're getting now will always be there, but if rates stay low, well, some of them might have bad surprise, right? So we think they're pricey. Next page 15. So this page, I think it's great, and it shows you the sensitivity analysis to what could happen, let's say, for the HPR yield based on what happened to the 5-year rate Canada, right? So, and you can see that we're starting at 560, which is great, right? Like I said, and that even in late 22, we're going to be in a similar range. Some people might ask, why are your yield increasing for the next 2 years? It's because in our assumptions here, we are assuming that the high resets will get redeemed, so we have to reallocate the funds, right? And those that will get redeemed as a yield to call, because we're looking at the worst of them, really lower than the actual real right now. So that's kind of why it's getting you a boost, right? So remember, like so up to late 2022, end of 2022, there's, even if rates stay at 0.5, your yield is not changing, right? Why so? Well, I can explain it, but also because 5 years ago, 5-year rate was low, right? So, but after that, now you see at some point in 2025 some downside. If rates stay at 0.5, right? If all the resets reset at 0.5%, so you end up at 514, which is still above 5% in this extremely low interest rate environment. So
Right.
And after that, there's
Nick, and I love this chart because it shows what would happen if the 5-year rate were to go up to 1%, and then that yield would be up and then stable in those years. And then even if the rate, the 5-year government of Canada went down to 0, you're still getting a very attractive yield, especially in comparison to obviously a 0 on a government of Canada.
Yep, that's exactly true, right? So that's gonna explain why we like the pref, right? Cheap yield, massive redemptions coming, which will put a bid in the asset class. Don't expect much supply. It will be a bit boring, and at some point, we're not there at all right now, but at some point, maybe we will see higher 5-year rate Canada. We might not stay at 0.38 forever, and we don't believe in negative rates in our team. So from now on, we think they're just upsides in rates, so higher. But it might take a year or 2 or 3, maybe it's 2023, right, that we start seeing the 5-year rate increasing a little bit. But this is another potential upside with pref that you don't have with high yield and bonds, right? So that's also something pretty interesting. So to kind of finish, some people might ask me, okay, what's the upside? From now on, I think for the next 12 months, I think well, yield is around 560, right? 50% is trading at deep discount, and I think there's big upside for those, even for the one trade at $21 and $22, right? So I think that's assuming that the credit zone remains intact, that the pandemic, the second wave is not too crazy, and that I would suspect, and that the LRCN market remain open, which is important, right? Well, we're expecting between, I would say, 8 and 12% total performance for the next 12 months. And I think I am on the conservative side if we're right with all the redemptions and potentially more redemptions that could happen. So it's still cheap. Yes, we lost the last 11-12% since the announcement of those LRCN. But we just add so far close to 2 billion of redemptions, and there's another 12 billion coming for the next quarter, which will again be, I think, pretty positive for the asset class.
Thanks, Nick. That's a great summary on the potential opportunity in the preferred share space, especially within the larger fixed income environment with yields so low, and how well traditional fixed income has done, and that you foresee further issuance in the LRCN market is going to continue to cause redemptions and really provide that opportunity for preferred shares and receiving that attractive tax efficient yield in the meantime, and with some potential upside. So thanks for that summary. I think you did a great job presenting that case and that opportunity. I'll just quickly review some of our two actively managed preferred share ETFs with Horizons. The first being HPR. This is the largest actively managed preferred share ETF in Canada. It has about 1.25 billion in assets in it. Right now it is yielding about 5.65%. Again, that's tax efficient Canadian eligible dividend. Has a management fee of 55 basis points. Note that this is only slightly higher than a passive index, and we believe the active management in this space can add value and can add more value than that slight increase in management fee, partnering up with Nick and the excellent team at Fiera Capital. And we also have HFP, our active floating rate preferred share ETF, and this has more exposure to the rate resets that Nick has described through his presentation. Same management fee and a very slightly higher yield, but actually as of now that would be quite close. So in summary, why Fiera Capital, why Horizons ETFs managed by Fiera Capital? They are able to provide that true independent credit analysis. They're not simply relying on credit agencies to determine the value or the credit worthiness of those issuers like an index might. They can really dig in and try to find the true value. And as Nick mentioned, that sweet spot right now after the higher rate resets have already been priced at par, is trying to find that sweet spot of those preferred shares with that yield spread that might get called and have that upside potential in price. Fiera and Nick are not constrained by index methodology, and they can go find the best opportunities in the preferred share space. And they do have that institutional access, being one of the largest players in investors in this space. They get the access to new issues. They can be very selective in portfolio additions. And when there are large block trades, they're likely one of the first calls, and they have sort of negotiating power or buying power, and can help set a price on some of those large institutional sized blocks, which then ends up helping the unit holders of our ETFs. So I wanted to take this chance to remind people of what an opportunity called in-kind subscription process. What we're able to do is we're able to accept individual preferred shares or preferred share ETFs on an in-kind basis. There has to be a certain minimum, and it has to be approved by Fiera Capital. But what we're able to do is accept individual preferreds or preferred share ETFs into our ETFs on an end-of-day NAV over NAV, and there might be a very, very small commission placed on by the executing dealer. But that's an opportunity without having to sell and buy. We can do it on an in-kind exchange basis. If you need more information on that, please contact us. But it's also that time of year where you might look at some tax loss selling. If you've had some individual preferred shares or a preferred share ETF, and if you happen to be down depending on when you purchased it, you might look at selling it and buying the preferred share ETFs, and even in the in-kind exchange process is a taxable event. And what that does is then you're harvesting that tax loss to be used against gains going forward. But also the main benefit is then you're able to reset your ACB within your statements, and then ideally take advantage of this LRC and rally going forward. So harvest a tax loss, reset your ACB, and ideally participate in some positive returns going forward in the preferred share space. So I'll just highlight quickly some performance that you can view. I've talked about the 3-month returns. You might want to look at, as that's around the time frame that the LRCNs were issued near the end of July. You see a nice return since then. The 6-month return, which is closer to market bottoms in March, so there's been a nice rebound. And then you're seeing some consistency over a 1-year and a 5-year return, with HPR being a consistent performer in the top half or top quarter of all preferred share ETFs over almost every significant time period. And reminder that you're still receiving that tax-efficient yield of about 5.5% right now. So that really does complement the traditional fixed income that has done so well in the last couple of years. But now you're sitting with traditional fixed income at very, very low yields. The Canadian aggregate bond index would be lower than 2. The Canadian 5-year government of Canada is 38 basis points today, and even a U.S. 10-year Treasury at around 80 basis points. So hard to get attractive yields from traditional fixed income. So complementing that traditional fixed income with preferred shares, higher tax-efficient yield is an idea for sort of those fixed income portfolios. And we'll just scroll through some of our investment objectives of the ETFs we have discussed. And a lovely disclaimer. And then I'm just going to remind everyone on the presentation to please contact us, reach out to us if you have questions or inquiries. We are social. Our email is info@horizonsetfs.com, where someone can help you there or guide you to one of our sales teams. We're on Facebook, Twitter, Instagram, and LinkedIn. And for any advisors on the call, please email your wholesaling team to reach out for details on anything you have questions on. So I'm going to now open it up to questions. Nick, timely call today for many reasons, but one of them being the Cenovus and Husky, the Cenovus taking over Husky or merger. I'm not really sure how they positioned that, but the Husky preferred shares got a nice bounce yesterday, I noticed, which was nice to see. So I think some people were wondering on the Husky prefs, and and one specifically, would it make sense for Cenovus to buy the Husky prefs? HSE.C at 18, and will these Husky prefs be attractive from these levels once the merger takes place?
So all good questions. We're overweight on Husky, right? So by 1%. So of course yesterday was a good day for us on that matter, and it's also, I think, an interesting point to say that CPD sold almost all their Husky exposure in March at the worst moment ever, at the March rebalancing, which happened mid-April, because the dollar price of those were too low, right, to be in those in the benchmark, which is, I would say, not a good thing to do in a pandemic, right? Sell at the low and at the worst moment ever. So despite all this, for us, we kind of kept the exposure. We like the name. It performed pretty well yesterday. It's still low, right? But we think there's a lot of upside. So fast forward with this combined entity with Cenovus, we think that yes, at first leverage for the entity will be worse versus Husky leverage right now. So that's kind of the reason why there's a bit of expecting downgrade for Husky, but the bonds of this new entity will remain investment grade, which is a great news. So Cenovus bondholders will move up to BBB low, and for us it will be a big energy company, better diversified, right? And which will be a good investment down the road. But it's all going to be about the oil price, right? they want to decrease leverage, which is good, but they want to decrease the leverage a lot for the next 2-3 years, right? From 4 or 5 times to 2-ish times. So that's a lot of leverage to decrease. But if they do so, we think it's going to be an improving story. But you need oil to be 40 plus, right? And ideally 50 plus, right? I know they're saying the break evens will be in the low 36, 33 a dollar in 2022, 23. But if you want upside with this company, and for the investment, I think that's you want to see higher oil price. So for those pref now, your yield is 7-8%, despite the nice rally yesterday, and it's one of the cheapest pref out there. And we want to keep our exposure for now.
Okay, thanks, Nick. There's another interesting question I hadn't thought of, but we've discussed the LRCNs have only been available or issued to institutions. And what's your rationale on why that is the case? Why did they decide to only issue those to institutional investors and not retail investors?
I think both OSFI and banks were unhappy before with the pref market being their only market to print AT1 before the hybrids, let's say, and when retail was buying, and it was no problem. But lately there was just not enough buying, and valuation was lagging a lot. The global valuation of the global banks for hybrids, right? So that was and I think that was a main reason for that. And you can see this type of reasoning too in Europe. Their hybrids, they want to sell to institutional investors and not retail. They want to be sure and that retail is, when it's buying it, it's through funds or whatsoever. And that's so. So that's kind of the reason why. So, and I think it will stay like that for at least primary market. I think retail can have access to those that are seen in the secondary market, right?
Yeah. Okay. Yeah, in the primary market. Okay. Excellent. I think you did a great job positioning your outlook and the opportunity for the next 18 months, which is why we probably got a question on, what's your outlook on the preferred share market beyond Q2 2022? With all the redemptions you foresee, are you concerned of lower credit quality of prefs at that point?
Beyond 2022, I think if the credit environment is still holding well, and in fact that hopefully we won't be in pandemic, so I think spreads for everything could be even tighter versus the current level. So we might get the second wave of redemptions, right? So I know second wave is not a popular word, but for the redemption it is. So I think that could happen. But when you fast forward this though, with all the redemptions that will happen, that could happen if the LRCN market remain firm, right? We will end up with the market smaller, right? So more volatile, less banks, life insurance, and good issuers. So because we will see a lot of those redemptions, so less good issuers, we will end up with the reset quality for the overall market worse, because the high resets, the coupons will all get redeemed. So we'll end up with a more volatile market. So it's all going to be about what's going to happen with rates and credit environment, right? But for HPR, remember that we can buy hybrids, we can buy LRCN, right? And we will buy them when we will want to reduce risk in the funds, right? We think it's way too soon to do this, right? We're kind of talking about late 2022, or still in 2020, right? So we have so much times ahead. So right now we want to stay within those kind of mid resets, 250, 300, lots of upside. Some of them might never get redeemed. It's okay, but maybe instead of trading at $20, they'll trade at $23 at some point. And so that's why we're on, and that we will buy at some point more hybrids, more LRCN, and that will be a mix of and that will be our way to get access to those good issuers that are printing away from the pref market, right? So we have this ability, other product they don't have, right? So that's I think an advantage for us, and I see a future for hybrids type of fund that includes pref, hybrids and LRCN, and I see and my role would be to just try to buy BC, which one is cheaper. Well, right now
Yeah,
there's just okay, but
yeah,
banks,
the
Enbridge,
best.
and whatsoever, right? So and there'll be a futures for this and this type of asset class, like there is a market for high yield, right? People want yield, and hybrids with good issuers, there's a future for that, and it will be now maybe a better mix with hybrids and LRC and pref, right? Instead of just pref.
Hmm. Okay, excellent. Yeah, and being able to have those options going forward and finding the best value and yield, um, good, and something you'll be looking at in the upcoming 18 months. You touched on the rate resets just there in your answer and in the presentation. We have a question on some of the bank resets within the low 300 range. Would you expect them to be trading a little higher to 25 now if you're thinking they're going to be called or redeemed? Like BMO and TD, for example, have some issuances trading around below $23, but their resets are a little over 300.
Well, what's important to analyze on those LRCN is that TD and RBC are clearly the ones that have access to cheaper level on LRCN, right? After that, it's BMO, and it's kind of finishing with well, we don't know Scotia, but I would say Scotia's ABC National will be a bit wider, right? So those BMOs in the low 300, if it was today's decision, for sure, BMO will redeem them at par, right? And it's just that the redemption is in 2022, so there's still some time. So it's not. I did not put them in my table for the potential redemptions, but clearly it is a potential. Those are potential redemptions, right? And they used to trade in the low 20, now they're in 23 at some points. One of them, I think, is the C's Rich 24. Those two, if the tone for the LRCN market remain as it is right now, yes, I think they will get redeemed.
Right, but there's some time. There's some time.
There's some time, right? So
okay.
and it's like I'm expecting a strong market with those redemptions, but in between redemption, I'm expecting again is still a choppy market that will be that performance or volatility will reflect what's going on in the overall market with the election, with coming next week, with the pandemic, of course, right? But I think that this massive potential redemption will bring a nice bid to this market and will outperform.
Good.
Finally.
Yeah, thank you. That's a good explanation. And one last question. We had one of our callers sort of inquire on an explanation or clarification on again why it's cheaper for the banks to issue LRCNs as opposed to preferred shares. And from my awareness, I believe it's just that the LRCNs they can issue or they can pay that out pre-tax, and with preferred shares it's on an after-tax basis. Is that correct?
Yeah, right now they're saving on that, right? And the example I showed you, like RBC, they print in reset equivalent was 286, and I'm looking at a preferred share, same issuer at Royal John, right? That is the reset of 274, so it's a bit lower, but pretty close, right? And this issue is trading at a little bit more than $5 discount out of 25, right? So that's a massive discount, right? So which means for me that if RBC would like to print a pref, they cannot print a pref at par with the same reset as the one that is trading at discount, right? So no chance. So that's why they'll have to pay way more to have access to the pref market. But the real advantage of those at RCN, first it's valuation, but after that it's to who they sell. They sell to institutional investors in Canada. They also have access to global institutional investors. So the first deal, RBC, I think a quarter of the deal was sold to investors outside Canada. So,
oh, wow.
So I think it happened a little bit in late 15, early 16, when the pref reset were kind of really high that they were able to sell outside Canada a little bit, but that's it, right? So they just have access to much more money with those LRCN, and they can align levels to more closer to the global hybrid type of levels. And that's why RBC, the first deal was 1.75 billion, the second one was 1.25, right? So those are all the key reason
Yeah.
why banks are. But the real one, let's be honest, the real one is because they're saving a lot, right?
So they're saving a lot, and that's obviously an attractive yield for an institutional investor from a a large global bank like RBC. Okay. The one final simple question was, does the in-kind transfer create a taxable disposition? And the answer is yes. It does create that taxable disposition. It can be treated as a tax loss if you're in a loss, and if it's a gain, there would be a gain. But the large benefit is saving on spreads on each side, and that's the benefit of the in-kind exchange program. So Nick, I think we're going to end it there. Again, thank you so much for taking the time to sort of present the opportunity in preferred shares, and how LRCNs have provided that opportunity, and what you're seeing in the next 18 months or so. And thanks again to all of our attendees. Very well attended webinar. So there is a lot of interest in this space. A lot of people wondering if they should be looking to invest more in preferred shares, especially with yields so low. So I hope this was a good use of everyone's time. I hope everyone took something away from it. Please reach out to us if you'd like to learn more. And for any questions I might not have been able to get to within the hour time frame, we will try to reach out to you and answer individually, or please contact us if you do have any further questions. So with that, thanks again, Nick. Thanks to all of our attendees. Have a great day and stay safe.